when I started buying multifamily, it was thrown around and it was used as a metric to say, boy, you're getting a real bargain on this property. Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in this video, if you want to learn how to properly evaluate and put value on a multifamily property, then you need to listen. There are typically three ways that appraisers use to evaluate property values, specifically in commercial real estate. Let's start with the first two ways that they're more used to me, I think, in residential and sometimes in, when you're looking at, let's say, industrial. We're going to talk about the first one, which is the sales comp, right? You're going out there, you're looking at a property in residential, you're on Zillow, you're looking for a 3-bedroom, 2-bath property. That's the sales comp. What does that one sell for? What does mine sell for? Is it 1,800 square feet? Does it have 3 bedrooms? Is it 2 bathrooms? Is it a quarter of an acre? Does it have a pool? That's the sales comp. It's a pretty easy way to evaluate. And what I really like about residential more than commercial is it's just open source. It's so much easier to find values. Everything's online. You go to Zillow, you go to Realtor, you can find out almost exactly what your property is worth. Now, there may be a little bit of differences. There may be some nuances. You may have some upgrades in your home that the home down the street doesn't have. Well, does it get lost in translation? I'm not sure if it does. What I like to look at is I want to see like for like. Is the square footage similar? Is the neighborhood very similar? Is the build similar? Sales comp. Now the next one is pretty interesting. And when I started buying multifamily, it was thrown around and it was used as a metric to say, boy, you're getting a real bargain on this property. We call it the replacement or the cost approach. Now, in 2013, we bought our very first assets for $25,000 per unit. I remember the first asset we bought. After that, the first one was $25,000. Then the next one, we bought it for $23,000 a unit. Now, to replace that back then was probably $75,000 to $100,000 per unit. So we're buying it vastly below replacement. So in our minds, we're getting a deal on this thing. We can't build this for this much money. And you might be saying to yourself, well, how are you buying it so low below replacement? And it's because of the third way you evaluate multifamily or you evaluate commercial real estate. It's called the income approach. And I've been speaking to appraisers recently, and the vast majority of their appraisals, they're using the income approach. And it's really a great way to buy a property, and you're buying it now based on the actual income of the property. You're looking at the net operating income of the property. That's what you're looking at. You're looking at how much income does this property derive or does this property generate? I love using this. It's because you're buying a property and you're not looking at, the amenities, you're not looking at the square footage. Although when you're doing your analysis, you like looking at that stuff. But what you're doing is you're buying a property in a market, and you're also sort of using the sales comps down the street, because you're saying, oh, well, the property down the street sold at a 5 cap. Okay, great. So my property should be selling at a 5 cap. Great. But what does that property, generate? What does that NOI generate to be able to hit that 5 cap? And that's what's really important. And that's why I love multifamily and I love commercial, because you're buying it at an actual income number. And if you know what you're doing, you're able to force the appreciation. I mean, to me, in this business, it's all about that net operating income and being able to move it upwards, being able to derive value from it. And how do you do that in multifamily? Well, there's basically two ways, I think, in any business to do it. You're either increasing income or you're decreasing expenses. So that's what you're focusing on. When an appraiser looks at a property, he's doing an analysis. He's taking a person's income in a property, person's expenses, and he's deriving that net operating income. Now, for purposes when you're analyzing a property, you really need to take a look at that income, but then you need only operating expenses. So expenses to operate a property, such as garbage, such as utilities, such as property taxes, insurance. So that income of, let's say, $10,000 subtracted by $5,000 in operating expenses gets you the $5,000 of your net operating income. Anything below that, anything below expenses below net operating income would be what we call a capital expense. A capital expense is anything, a repair on a property that's lasts longer than a year. So let me give you an example, because sometimes this is confusing to beginning investors. If you're repairing a roof, that's an operating expense. That goes above the net operating income. If you're replacing a roof, that goes below the net operating income. That does not affect value. It does affect cash flow because it's still coming out, but for tax purposes, it's treated differently. It's a capital expense. When you're looking at other expenses on the property, when you're repairing a hot water heater, that is an operating expense. When you're replacing it, it's a capital expense. It goes down below. So what you're trying to do in multifamily, this is very important. You're always trying to look at what an NOI is, trying to buy it on the income approach. And from there, you're trying to raise that NOI. As you raise that net operating income, you're forcing the appreciation on the property. It's really good to know the other two valuations. You're rarely, if ever, use them, but it does make you feel good when you're buying these properties at, let's say, $125,000 per unit, but to replace the asset that you have right now that you're currently buying, you need to spend over $200,000 per unit. That may make you feel good. But at the end of the day, when you go to sell that property or to refinance the property, that buyer or the bank is going to look at what your income is in the property and do the income approach. Now, what I want you to do as you're listening to this, I want you to subscribe to our channel, because what we've started doing is on the channel itself, we're starting to release our weekly masterclass Mondays. We're releasing a couple every month. That's behind the scenes. That's stuff that we do weekly with the Jake and Gino community. If you subscribe to the YouTube channel, you're going to have access to these recordings. So down below, there's a subscribe button. If you like the video, click the like button. If not, I want you to subscribe to the channel. You'll be getting fresh content that's behind the scenes that we don't publish out to the rest of the world. It's just from the Jake and Gino community. And I want you to become part of the Jake and Gino community. Now, if you have any questions, any comments, leave them down below. And always think about multifamily as buying it on the income approach, forcing that appreciation, pulling that equity out. I want to thank you for spending a part of your day with Jake and Gino, spending part of your day with me. And listen, it's an honor just to sit here and be able to talk to you about multifamily. It's changed my life dramatically, and I want it to change yours as well. Thanks again, and I'll see you on next week's How To. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.